Hey everyone, welcome to the weekly review. This week, aside from that scare on Monday, which probably happened because European markets was closed and it was less liquid, we continued going up. We had a breath trust trigger on Thursday, and things continued to be quite constructive, surprisingly so, at least in the short term. Let's take the volume patterns here. So we tried to go up. We made this 90 down vol. Tried a couple of times to make another one, but failed. You have to look at the way the candles looks like. It always tries to recover a bit at the end. Then we had the 90 U vol. Tried to go down. It was safe. Like we have a hammer red candle. And since that 90 U vol, we have 1, 2, 3, 80 plus days, and we have 2 down days, but the down days are more bullish than expected. I mean, recovery here, try to go down and make the 90 here and recover. So bears have tried to recapture control and have failed 2 times, and we have more bullish impulsive moves than we have bearish ones. So things look constructive. We are also above the God candle. Basically, this was the God candle here. Change to my usual color. And it was to be expected that we will go within the range of this candle for quite a while. And on Friday, we actually closed above and went slightly above it for SPX. I think Q goes above, so this is QQQ, we are above. US 30, we are not above yet. And US 2000, we are above it. So all major indexes except Dow Jones are above that God candle level, the top, and this implies more bullishness. We have a follow-up from Walter Deemer about the breath thrust. So breakaway momentum is very unlikely that it will happen tomorrow unless we get a huge 90 vol day. Unlikely, but Wally is almost it will happen tomorrow with a high degree of certainty. It's very easy to get 755 advancers. And if we look at Wally breath thrust when it did happen, it kind of has a good record. Like this goes back to 2008, triggered here, and we made new lows. This is why I said it. Even if we get a trigger of this doesn't invalidate making new lows, and I still think it's possible that we do so. But with the current context, I think it's more likely that we do an equal lows or a slightly higher low than going back down. And just like in 2008, if we do some pattern similar to this, I expect we will get a confirmation breast signal once we start going up again. So we will get a cluster of them, not a single one. Then we have this one here, happened. This one is a down one. This actually is the bullish one. Also with a retest a bit later and also made new lows afterwards. And then it went higher. Then we have this one, this trigger at the top. Actually, it's a double trigger, one here and one here. And then had a bit of a pullback, but a scary one, minus 5.89%. This is after the COVID crash. This was the attempt of bears to crash it again, but which failed. And we went higher and higher after that. We have one after the 2022 lows, which came a bit later, like this was October and it came in January. And we went higher. We have one in November 2023. We have here at the top one. So usually when you get this type of signal at an extended top, it's more likely of a pullback. The pullback will come short term, but it still went higher afterwards. And now there's a chance we get it here. And again, things are a bit confusing, but generally bullish. So looking at this, let's look at what I posted on Friday. Kind of got what I expected, meaning because on Thursday we went up, yesterday was so Friday was supposed to be a more of a consolidation day, so I expected we go a bit sideways in this range here, but the fact that we are above the trend line and consolidating above the trend line and above the horizontal level of the God candle top is a bullish factor. I do think this move is overextended short term, so if we go up and hit the AVU up from the year start, this is it. I think we get a high chance of a pullback, and I'll explain why in correlation with VIX as well. But still think this level will hold, or maybe we go slightly below it to do this like this, something like this to do the back test, and we will continue up to get to this 560, sorry, 570, 580 election gap level. It's also the level where this is where we all started this pullback, this area here. Let me put a level on this one because that might be relevant for so 561. So 561 is where the breakdown happened. This was Liberation Day when we got liberated by our money, and initially went up, spiked, and then it went back down. So actually, let me do it on the closing basis because if there are people trapped in it, this is the closing. So this is the actual level. Liberation Day, what color we do? A purple. This. So this is the Liberation Day gap. Basically, people that bought hoping for a bullish Liberation Day will be selling this area. We might poke a bit above it, like actually hit 570, but actually this is a very big level because it's where people will be relieved that they're back to break even basically, and they will sell into it fearing whatever may come because of the Trump policies. So it's, oh my God, I'm back to break even. I'm getting the fuck out of it, and just waiting and seeing what happens because the Trump policies are still negative for growth, and the market might do a second leg down afterwards, and very likely to do so as well. The other scenario is that we actually go slightly above it and consolidate above it, but eventually fail to sustain a move above this level because maybe we don't get instant brutal selling. Maybe we get just slowly selling and no more buying. And then we should do a sideways move here. And eventually, once we go back below this level, we break down and go back to 530 or potentially lower, depending on this. Uh, but if the breadth trust trigger again, I think we get this, oh sorry, not that way. We get this five-way sequence eventually. So we go, let's say it's going to be here, we go down again and potentially do this. And only after we do this, once we get to around May OPEX, which is a bit early this year because we have the first Friday next week, and it's going to be 16th. So basically we have 3 weeks until May OPEX. 3 weeks in which we should be doing the whole five-way sequence, or there's the window of opportunity to do that. It doesn't mean it will happen. Maybe we actually go down earlier. And then the window of weakness between the 16th all the way until 20th of June, in which we have to be very, very careful with longs because I expect we will do the low retest here, potentially higher low, potentially lower low. We shall see how it happens. But this is kind of the setup. Now, why I think we should be getting, like, if we move higher, we should be going a bit lower is because VIX is nearing 23. This was my first target once I thought we would top out. You can see that it was a top here multiple times, the 23 area, even in the past, like here, 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 etc. So, but the thing is, when when we drop into it, it doesn't always hold at the exact level. For example, here we got a spike into 40 again, but here we actually went lower, like we went to 21 and a half, something like this. Because 23 is not really a big level, 20 is. I expect that we gap down. We go like somewhere between 20 to 23, and then we bounce. This is also a gap fill from Liberation Day, I think. Yeah, from Liberation Day. So this would be the VIX gap fill from Liberation Day as well. I'll redraw this because to try to make it more time accurate. So my expectation is that once we get to the 23, 22 area, we will do another spike probably to 30. Then we fade it again, and then we start going up for good, and maybe we do 40. We won't, it's very unlikely that we make a higher VIX level because the market doesn't bottom on the high of the VIX. Like for example, 2008 market, this was the first leg down, obviously. The second leg down, which went a bit lower, but the actual VIX bottom is not the market bottom was on March 9th. So market bottom, which market went significantly lower, was this. It wasn't this, it wasn't this, it wasn't even this. It VIX was significantly lower. Same for 2022. Low was on the 23rd of March, something like this here. So this was the low, and it wasn't the high in VIX. So I don't expect we will see that. Same in 2022. The low was June. Oh no, actually October. So this was the first low, then the second low, and then that's it. So you can see that VIX is making lower highs, and that was the bottom. So I don't expect VIX to blow up for the June correction. I don't expect VIX to blow up that high. But short term, we do this, and then we fade it back down. Um, spike. So basically, we do this, gets us a spike to 30 VIX, in which the index doesn't drop that much actually. Then we start going up. For this would be the move into 20. This would be a blow up later. We shall see how it plays out, but that's kind of the setup. Now, as to the long-term forecast about recession, like I said, it becomes complicated because if we get breast signals, it means market should be bullish. But this is the first sign of hard data rolling over. Container ships sailing from China to the US, rolling 15-day window. Now, regardless of what stocks do, this means the consumer spending will go down. Uh, First of all, the first effect is less goods, which potentially will raise prices. But with a consumer that is aware of what's going on and scared of what's coming, I think they will not spend as much. So first of all, we have less goods in circulation because fewer stuff is coming in from China and Asia in general. Uh, and the consumer that is scared, even if the consumer was not scared, or if the consumer was not scared, this would lead to inflation. If the consumer is scared, this doesn't really matter because the consumer was going to spend less anyway. So less goods is relevant if the consumer is spending just as much or more, because it will cause inflation. But less goods with a consumer that is not spending anyway just means they're not spending. So it's not that relevant. There may be a bit shortages, but I think the impact on inflation is overestimated because I think the consumer is scared anyway, and the fact that less goods will be coming in, uh, it will just mean people don't spend anymore. First of all, they don't want to spend. Second of all, even if they wanted to spend, there's not going to be enough goods around to for them to spend on. So this is forward-looking metric, in my opinion, we shall see the slowdown happening. Probably it will slowly begin tentatively in June, but it will become very big during July or after July. So that's kind of the setup right now. So, like I said, a bit complicated. Don't really know how to read this thing exactly, but take it day by day, and we'll see where we end up. My plan is to get out of all my longs if we get to around this place, and I still expect a bigger pullback a bit later. So I'll reassess if we get a pullback to here, and I think we still have another bullish leg in us. Probably get a few longs, but low amount of port for this new leg up that goes up to here, or it could be just like a double top here. Depending on how high we go, it also sets us our target, because in this area we just double it, and if the double top is to this level, I would expect a low retest. If it's not a double top and we actually make the full 5-way sequence with a new high to the yearly open around 590, I would assume once we go down, we will stop at 500 or 515, something like this. We'll see it as it plays out. But for now, we don't know. Nobody knows, so don't. And very uncertain times, we have to play it as things develop. That's it for now. Not that helpful, unfortunately, but it is what it is. Uncertain times. Have a good one. Bye bye.